Welcome, everyone, to the Directed IRA Podcast with Mark Kohler and Matt Sorensen. We're excited to be with you today.
Woo.
The great debate, baby. Are you ready to debate?
Yeah, I've heard of the great race. The great
debate. I think it was like...
Is there a great debate in history?
Yeah, like there's some presidential, like for like the fourth president of the United States. I don't know. Back in the day when they
actually cared about debate.
When they actually debated, instead of like insulting each other the whole time.
Yeah. There's Dan Rather going, "What do you think?" All right. Okay. All right. The great debate. So the question is, everyone, what is better? The Roth IRA. No, I'm going to rephrase that. That was bad grammar. The great debate. The question is the Roth IRA better than the traditional IRA in the long run? Which one wins when you take into account all the tax issues and rates of return? Mm-hmm. It's a big question. We're gonna answer it right here on this podcast.
Yeah, and this takes some math. Good thing we got Mark Kohler, trusty CPA, who has a calculator on his phone.
I have Siri. Siri, which one's better? She won't tell me.
Right. But we're going to break it down because this is complex. It really is. And it's a question everyone has to think about. You work at an employer and you're like, do you want this to be your Roth 401k or traditional 401k contribution? Yeah. You're going to open up your IRA account, maybe your self-directed IRA here at Directed IRA. Do I want to throw in $6,000 in my traditional or $6,000 in my Roth?
Yeah. And you know what's going to happen? Yeah, what's going to happen? They're going to remember this podcast.
That's what we hope.
They're going to say, what did Matt and Mark say? Well, people, you can send this to your mom. You can send this to your dad, your kids, your best friend. Don't send it to your enemy because this is powerful. You don't want to help them. This is for your friends and family.
Let them be lost. Let them be lost. Yeah. But I'm going to give a little, many of you who've listened to the podcast know we love the Roth IRA. There's many reasons for that. But the traditional wins sometimes. And so we're going to break it down. Sometimes it does win. And learning these differences and how they operate, I think, helps people make a better decision on whether to go traditional or whether to go Roth.
Okay. Now, spoiler alert. Mark Kohler might say the traditional never wins, but maybe. And I might say Wall Street sucks again. And I've even got a book titled What Wall Street Isn't Telling You. Right here, the book, Financial Freedom. I should have put a chapter on this. I think second edition is going to have a chapter on this. Because
I think the people demand it.
All right. Now, Matt, I've got the iPad ready to go.
Yeah.
So should I...
Let's lay out traditional versus Roth basics. Let's get everyone on the same page to understand how the heck a traditional works. What are the perks of it?
Yeah, and I could use that example that I shared with you before the show of just a one-time deposit maybe.
All right.
Okay, but you explain the basics. All right.
Okay. All right. So the benefit of the traditional IRA, what's cool about the traditional IRA or traditional 401k works the same here. When I put a contribution in, let's just say $6,000 in an IRA, I get a tax deduction. The government's like, thank you for contributing to your retirement account. You get a $6,000 tax deduction. All right. Now, if I'm in a 30% tax bracket, I just saved $1,800 in taxes. Okay. That's powerful. Okay. So remember, in traditional, tax deduction on the way in. Now, all the money grows tax deferred in your traditional. You're not paying taxes. It's growing and you got investment returns and everything. But on the way out in the traditional, there's a day of reckoning. You're going to pay tax as you pull the money out at retirement. So that's the traditional. Tax deduction up front, but you're going to pay tax on the way out.
Okay.
All right. Now I want to contrast that to the Roth. You ready for me to hit the Roth?
I'm writing fervently here. Everybody's loving it. That's able to watch this on YouTube. You're going to love it.
Okay. Now let's hit the Roth. If I put $6,000 in a Roth, I don't get a tax deduction. All right. So that $1,800 tax savings, I don't see it. Okay. But that money grows in the Roth, and at retirement, which is $59.5 for the IRS when you can take it out, I pay no tax on the way out. Totally tax-free on the way out. So if you're cool passing on the deduction now and paying a little more tax now, you get the benefit in the long run of no tax on the way out. Okay. Now, I don't want to do too much commentary on what we think, but that's the rule. And I think most people are familiar with that. It's the same for traditional 401ks and Roth 401ks as well.
Okay. All right. So I've just highlighted this in our 2 columns, and I think we get it. Now, I'll share an example. Let's say this will help illustrate the basics of the Roth IRA versus traditional IRA. Let's say you've got 10 grand. Now, I know the contribution may be 6,000 or 7,000, but let's just, for math's sake, use round numbers because we're just trying to illustrate the concept. Yeah. So let's say
this could be in your 401k too.
True.
Or maybe it's between January and April 15th when you can make your 2 years of contributions for last year and the current year. And then you get in 12. So we're good at 10.
Yeah, that's why I love my co-host. Great point. Okay,
yeah.
So we got 10 grand.
Right.
Okay, I'm going to put away $10,000. That's my investment in my Roth. Or is it? Remember, with a Roth, you got to pay taxes first. So this is not an inheritance from your grandma. This is $10,000 of earned income. And if you're doing it between January and April 15th, you could kind of piggyback 2 years to get your 10. And you say, I'm going to put away my 10 grand, but I got to pay tax first. Now let's assume a 30% marginal rate. Now what that means is on your next dollar, your effective tax rate is 30%. Now, I'm combining a Fed and state example. You might be in a federal 25% and state 5, or a state 10 and federal 20. Just work with me, people. I know some of you may be in Washington or Texas or Florida with no state tax, but let's just assume 30%. So 30% off 10 grand, got to pay my tax. I'm really only putting 7 in that Roth. Okay. All right. Now over on the other side, I've got my 10,000 I'm going to put into my traditional, and I get a tax deduction of 3 grand. Okay, that's pretty cool. Now again, states can vary on this. You may be in a state where you don't get the deduction. Just work with me again. Okay, so 3 grand. But I got 10,000 in the hopper. I've started that snowball going down the hill, as Dave Ramsey would say. And I've also got my 7 grand over here. That snowball is ready to roll down the hill. Now, let's say you get a 10% rate of return over the next 30 years. Now, save the hate mail. I know some of you think 10% is la la land. It's somewhere, over the rainbow. Mark, you've been watching way too much of, some movie. So hang tight. We're going to come back to address rates of return in a moment. But some of you know that Wall Street would stick with an 8%. But let's just go 10, easy math. That's $7,000 is going to be $140,000 30 years later. Just out of sight, out of mind, average 10% rate of return. The 10 grand is going to be $200,000. Now look at that. There's a 30% difference on the back end as well. But 30% of 200 grand is 60,000, and lo and behold, that's 140. So if you held things constant and you were in a 30% bracket on the way in and a 30% bracket on the way out, and nothing else changed, and you averaged a 10% rate of return in both buckets, you'd be in the same spot effectively if you were just going to drain the account and pay your tax, or take that tax deduction on the way in. That's a basic example, Matt. What would you add to this? Is this realistic? How would you explain this example, or a different way?
Yeah. I mean, look at the math. It's pretty cool on the way out. The reality is, though, someone's just going to do 10 and 10. It's more like, if I'm a traditional person, I'm going to put in 10. And I know I got a tax deduction, but I'm going to put the full 10 in, and we know that. But on the Roth person is going to put the 10 in and deal with paying the tax. Yeah. So Wall Street wants you to think that, well, the Roth person's not going to put all the money in.
Yeah. And they think the traditional person's, what are they going to do with that tax savings?
Yeah. They think they're going to invest that tax savings. Yeah. Which they don't.
Okay. Now that's a spoiler alert. We'll come back to that concept. But most people don't just put away 10 grand. What they're going to do, they're 6 grand a year. So Matt, tell me your example there. I think you had one. Okay. What would Wall Street say? They're going to say 8%, right?
Okay. Yeah. They're going to say 8%. S&P 500 fund. Go buy SPY or any mutual fund that models S&P 500. Returns over 8% over the history. So let's just do 8%. All right.
Okay. We got an 8% return over 30 years.
Over 30 years, making $6,000 a year in contributions. All right.
Okay. And I'm going to do the whole amount in the Roth and the whole amount into the traditional, because that's what people are going to do. They're going to find a way to pay the tax to do the Roth. Mm-hmm. Okay. So the 6,000, and it's going to grow at 8% over 30 years. Yep. And I'm going to put 6,000 in my traditional. How much is going to be in my buckets at the end of that time period?
750 grand.
Okay. I'm going to have 750K sitting in my Roth IRA 30 years from now. And the same thing sitting in my traditional at an 8% rate of return, because I did my 6 grand.
Compare apples to apples. You can throw 6 in a traditional. You can throw 6 in a Roth. Don't get caught up in this. What are you doing with the deduction yet? Like that's just, you want to put 6 in. People just like get the benefit of the tax deduction and spend it, or just bite the bullet and pay the extra tax, which is 6.
Now, on the face of it, you'd say, well, the Roth wins because I'm going to have 750 grand tax free, or 750 grand I got to pay tax on. And that's what Mark and Matt say every day of the week and on Sunday. But no, Wall Street, hence what Wall Street isn't telling you, they're going to go, no. You got to take into account that tax deduction. So the tax deduction you got on it, the traditional is 30%, which would be $1,800. Now, Wall Street, when they start to debate this, and you're going to go to websites where they go, oh, no, the traditional might win. The first thing they're going to want to tell you is that before they talk about tax rates when you retire, because some of you are already thinking, well, I'm going to be in a lower tax bracket when I retire. Hang tight. We're going to come to that. But the first main thing Wall Street says is you're going to invest that $1,800. What happens to that, Matt? What's the numbers on that?
Okay. If you invest the $1,800, here, let me go back and do it.
At 8%.
Okay, that's going to be $150 a month. 8% over 30 years. That'll be $220,000.
Oh, wow. That's pretty good.
Yeah. Now, if you're disciplined and do that, you take credit for this. We're just saying the reality is people don't actually do that.
No, they don't. So we're going to come to Mark and Matt's spoiler alert and kind of our BS alert that all
and
these
here,
folks.
Can I say what that would be too?
Yeah.
Like if you were at a 30% tax bracket, and you're saving $1,800 a year, that's $54,000 in tax savings in deductions.
Okay.
Over 30 years, if you were a stay consistent or average a 30% rate every year, you save $54,000 in taxes. That was the benefit of the deduction on the way in.
Okay. Now I know you've got a seed and a harvest example we're going to come to in a minute.
Yeah.
But let's finish this example. What Wall Street would like to say is, don't forget the deduction. And they're also going to say 8% return. You know what's interesting, folks, is we went to a lot of the Wall Street websites where they do calculators on what's better, Roth versus traditional. They wouldn't let you run a calculation with greater than an 8% return. Okay, keep that in the back of your mind when Matt Sorensen talks about the seed versus harvest. Okay, but under this example, the next big debate that comes up in Wall Street is they say, John and Mary, remember, when you retire, you're going to be in a lower tax bracket. So you need the deduction now. And this is your accountant that, was practicing 30 years ago. They're going to go, don't do the Roth. You need a deduction. Okay? Well, here's what we have found. Rule number 1. I'm going to say it, and Matt is going to say it.
Yeah.
We'll say it 2 different ways because sometimes it's helpful that way. Rule number 1. If the tax rate is higher later or the same or even within 10%, So let's say it was 30% now, and down the road, I'm in a 25% bracket, 30 or even higher. The Roth always wins. Because think about it, folks. You're going to get the same deduction later or pay the same tax later on the way out. So the tax deduction didn't help you on the way in. But rule number 2, if the tax rate is less by at least 10% when you do retire, then the traditional wins with this 8% model that we just explained. So this is where Wall Street and that accountant, that old stodgy accountant goes, you need the tax deduction because you're going to be in a lower bracket in the future. And Matt, you had a really good example for me before the show started when you start thinking about state tax rates.
Yeah. Yeah. So think of someone in California, and while you're working, maybe you're paying 30% tax rate on your income between federal and state. But then you move to Texas in retirement and that state income rate, maybe that's a 5% or a 10% swing. I don't know your income levels, of course. That's off the table now. And so now the traditional actually becomes a little more valuable because I'm not paying tax on the way out on that little piece on the state side of things. So for those with traditional accounts already or saving with traditionals, if you retire in a no income tax state, you're going to get the benefit of not paying tax on the way out.
Yeah.
Even if you accumulated and got all the deductions in California on your California income taxes you were earning. Yeah. So that's a good caveat, and it's happening a lot. How many Californians live in Texas now?
Yeah. When I was just going to use and the Washington State example. A lot of people moved to Washington. That's why Seattle had a huge boom in King County over the last 20 years, is because Californians are like, we love it up here. We love the Seahawks, the Mariners. We're going to go up north, cool off a little, and no state tax on retirement.
Yeah.
So, okay.
So let me say this when Mark's saying a 10% swing. I just want to make sure everybody's understanding this. Let's say when you're working, you're paying a tax rate of 30% and you're saving, you got a salary or you got income from your business, you're paying an effective rate of about 30% state and fed. But when you retire, your salary leaves, and now you hopefully you built up some other passive income. You're starting to get Social Security, which is taxable, by the way. You start drawing on your retirement. That bumps up your income too. You get some rental income, whatever. You know what I mean? You got some income now. Now maybe you're at a 25% tax rate. All right. The Roth is always going to win. You've got to have,
because the change is only 5%.
Right. Because the change is only 5%. You've got to have a greater than 10% swing in retirement for the traditional to win out.
Right. All right.
And that assumes an 8% return. And we've ran the numbers in the models. So if you say, all right, Matt, I was at a 30% rate when I was working, but I'm at 15% in retirement. Now is the traditional make sense? Yeah, because the value of your tax deduction, on $10,000 was $3,000. Versus the tax you're paying on $10,000 on the way out of only $1,500. So you netted out there. You made out better. You know what I mean?
Yep. I love it. Okay. Now, everybody, here is the reveal. And this is where we piss off a lot of...
This is like the magician.
Yeah. I'm going to do David Blaine. Okay. Now, here's the reveal. And this is where we piss off a lot of the Wall Street cronies. And this is what you're going to not find on any of those Wall Street supported websites that are doing this comparison. They're not going to talk about these three things. So for those watching on YouTube or those regular listeners on our podcast, this is where you hope you go, I got to be listening to this podcast and share it with everyone I know, because this is the big secret that Wall Street doesn't want to talk about. So there's 3 points. I added a third one, Matt. I'm going to surprise you.
Okay. All right.
We had 2.
We talked about 2, but
okay.
All right.
Okay. Here's number 1.
All right. Okay.
The big assumption that your Wall Street advisor or accountant is going to make and talk people into here is that you're going to be in a lower bracket when you retire. And this is where our BS-ometer goes, rip. I have not met with a client ever that wants to make less money when they retire. Have you, Matt?
Yeah.
I haven't. I don't know
They're
who
not
these
shooting
people
for
are.
that. Yeah. It can happen, but they're not shooting for it.
No.
Yeah. And do you think tax rates and policy is going to lower rates in general on the same income levels? Even let's just say the rates will probably be higher in the future. Let's be honest.
Mm-hmm. Okay, so that's BSometer 1. So whenever your accountant or financial advisor goes, you're going to be in a lower bracket, you got to go, whoa, whoa, whoa. I don't want to be in a lower bracket. And by the way, if you looked at Washington administration right now, tax rates are going up, not down.
Yeah.
So that's...
And I would add, remember that issue of, here, let me say this actually, because there's a little truth to that. But it's not an absolute thing. That's the problem, is when Wall Street and all these advisors say this is like absolute truth to them. Yeah, if you had a day job and you saved in your 401k and you had a good salary and then you retire and you had nothing else but a retirement account, you had no other income but that job you left. That's who they're talking to. They're not talking to the small business owner. They're not talking to the investor. They're not talking to the person that builds rental properties. They're not talking to the person that built a large retirement account, which is going to get taxed on the way out. If you want to be taking $100,000 a year out of your retirement account in retirement, that's going to put you in a $100,000 tax bracket. Okay, it's replacing maybe what you were making before, and that's what we want. We want you to have a large enough retirement account. But what they're thinking is, no, you made $100,000 while you were working, and then you hit retirement. And now you make 20, you make 30, so you're in this low bracket. No one's shooting for that.
I hear you. Okay, now I'm supposed to be in a training meeting with some of our accountants and attorneys right now, and I'm just telling them we're finishing up the podcast. Now, second reveal. No one saves that tax savings. In our example of $1,800 a year, if you're putting in 6 and you're saving 30%, what do you do with that $1,800? You're going to go pay down bills, pay off debt, help your kids in college, go on a trip, buy a big screen TV. And you know what? I'm not opposed to that. You saved your $6,000 and hopefully you're out of debt. That $1,800 is a tax refund you should enjoy because you did your savings.
Yeah.
No one freaking goes and saves that. They really don't.
They don't. That's the reality of what we see over here and stuff. Because what they're saying is, that $1,800 you're putting every year into a taxable other like brokerage account or other investment that's getting you the same return. People aren't doing that. No. They're throwing the 6 in traditional or Roth. They're not throwing that $1,800 in also somewhere else to help this model an argument that the traditional wins, because that adds $200,000 to the model over 30 years, if you remember back from the numbers. Which
some of you naysayers. Oh, go ahead. Finish that point.
Which sounds good, and it makes the math work out to make the traditional look more beneficial. Yeah. And if you were disciplined and actually did that, good for you. The traditional may work, assuming you're not gonna, the tax rates we're talking about here don't have this 10% swing. So I don't know. The reality is people just don't do it. That's all.
Now you made a concession on point number 1. Yeah. I'll make a concession on point number 2. Here's my concession. Do we encourage our clients to use that $1,800 and go buy a rental property? Go build their small business? Does that $1,800 really have a time value of money? Sure, it does. And I would hope my clients use it wisely and build more wealth outside of their retirement account. And some do. But again, in this model, you can't treat it as an absolute. Like, we just can't presume that every year that $1,800 was invested properly, wisely, and it was of use to you. Some years it's not. Hell, that $1,800 sometimes gets sucked up in other tax bills. So, I get it. There's a time value of money there. It's a benefit you got now. You got to give it a value mark. Okay, I can concede to that. Fair. Yeah. All right.
Our experience is no one does.
No one does.
Go ahead.
Okay. All right. Now, third BSometer alert. All of these models, which I said a little earlier, that you'll find on Wall Street supported websites, cap this analysis at an 8% return. Do you know why? Because if you start calculating this at a 9, 10, 11, or 12% rate of return, the traditional never, ever, ever wins. As Smalls would say in the movie Sandlot, since 4th of July was recently celebrated, never. So it doesn't, because of a concept that Matt Sorensen, the leader in this industry of self-directing, has coined the phrase seed versus harvest. Matt, would you please explain, pray tell?
Yeah, well, some other people have used it, but I've really brought it to the forefront.
Okay.
Seed and harvest. But so remember, on the traditional, you're getting a tax deduction on the seed, the little $6,000 you're putting in, but you got to pay tax on the harvest on the way out when the thing's grown. And if you have awesome growth in that, getting a tax deduction on $6,000 you put in, but having to pay on the $6,000 on the way out, plus the growth of that $6,000, you're paying a crap load of tax. Now, wouldn't you rather switch the dynamic? Don't take a tax deduction on the way in, as you do with the Roth. Be like, I'll pay the tax on the seed. I'm okay with that. Let me pay no tax on the harvest, though. Can I get that deal? That's the Roth IRA.
Yeah.
And so when the harvest is really large, and you're going to get a 10% return, our clients that self-direct and can have a huge deal go through because they're investing in what they know, they'd be fools to use a traditional IRA. They don't want to pay tax on the harvest on the way out. And so that's going to be the large number. So when we talked about this, $6,000 a year turning out to be $750,000, well, $6,000 contributions over 30 years is $180,000. Okay. Would you rather pay tax on $180,000 or pay tax on $750,000 on the way out?
Yeah. So let's use an extreme example that's been in the news. We covered this on our podcast at Main Street Business a couple weeks ago. Peter Thiel, one of the founders in PayPal and Facebook, or I could say initial investors. He had a Roth that he used for both of those projects that is now worth $6 billion. Now, do you think Peter Thiel would go back in time and trade that investment for a tax deduction 20 years ago? Or do you think he wants that $6 billion tax-free? Obviously, he'd take the tax-free bucket. Now, this is where we get hate mail too. So let's go back to this rate of return concept. I know this makes some of you so mad, but I'm just going to say it, and please investigate it. Go out and get 3, 5, 10 opinions. I will stand by it. When you start self-directing, on average, and you start investing in what you know, which could be real estate, crypto, precious metals, small business, venture capital, that's what Peter Thiel did. When you start investing outside of your Wall Street controlled brokerage account, which they call self-directed, but it's really not, that brokerage account is going to average between 6, 8, or 9%. But a self-directed account, if you're lucky, a self-directed account, and again, this is where I've got to be careful for potential lawsuits and everything. I'm going to say this results vary. We are not guaranteeing this, but what we see, well over average, are rates of returns of 15% or more. They do the Peter Thiel. They have the Peter Thiel experience. They're doing real estate. They're doing all sorts of small business projects with a Roth IRA, where the harvest is far greater than 8%. Now, that doesn't mean it's going to happen to you. You can invest your Roth in something startup and lose it all. But on average, our Roth investors have huge harvests that are never taxed. Did I say that well enough to avoid a claim?
Yeah. Yeah. I mean, that's not our role as investment advice, but we do see the accounts and the success people have. And it's true. In a self-directed account, though, I'll say this, there's more wipeouts than just buying XYZ mutual funds. So but there's also a lot more home runs. And so Depends on what you want. And that's why we say invest in what you know, the assets you know. Don't just feel like you're restricted to Wall Street. But even if you're like, okay, guys, I don't even know what the heck you're talking about self-directing. Just think of this traditional Roth concept buying the S&P 500 fund. It's an 8 to 10% return. Most Wall Street brokers and advisors cannot beat it because they take their fees. They get you in stuff they think they can beat it, and they don't. And so just even if you assume that, the Roth's still going to win out. But the exceptional cases of where the Roth is obviously a better investment. For those of you that do know investing, that know what to invest in, whether you're a real estate pro or you're in tech and you want to invest in other tech startups or whatever it is, private money lending, we see clients loaning at 10% plus 2 points. I mean, those are awesome rates of return that are gonna beat the market. So
over and over. Now I have to take issue with something my co-host said, and I'm sorry. He said there's going to be wipeouts and there's going to be home runs. That makes no sense at all. What I think he meant to say, sometimes there's wipeouts and sometimes you get barreled. That's a surfer term. Okay.
I think it maybe strikeouts and home runs.
Probably. I think, yes. You could have gone.
Wipeouts and getting barreled.
Yep. For those of you that have surfed before, maybe on a wild and crazy trip to Hawaii and you got a surf lesson and you surfed a 1 foot wave, it's fun. I get it. But once, Matt, on the North Shore, I had the chance of getting barreled. And it was one of the most scariest experiences of my life. Because when you come down that face and you're looking to your, and I'm a goofy foot. So my right foot's forward, I'm going left, I'm coming down the face, and I see the barrel starting to form. You have a split second decision. Now I'm looking down at coral about 12 inches below the water, just flying by me, like at 100 miles an hour. And then I see this barrel, a 6 foot wave, ready to crash, and I have a choice. I can either bend down, get low, and pray that I don't get pummeled into this coral when the barrel ends, or I can turn right and then just surf the whitewater in.
Yeah.
I chose whitewater. I have to. I did. Because it's scary. It is so scary. It's one of I'll never forget that experience though. It was a thrill of, I come down the face, I'm curving, I'm turning. I felt like I was, a pro surfer. I was loving it. And then I had that split second and I blew it. I kind of got barreled once before on a right, on another wave a year or two later. It was kind of hit my back, but I didn't get the full barrel experience. And now I'm getting too old. I just dream about it. Maybe someday,
Yeah. You get back out there.
I got to get back out there. So sometimes you wipe out people. Sometimes you get barreled. And
there you go. Thanks for really explaining that better.
Just wanted to throw that down.
Yeah. Wipeout and home run didn't make much sense.
Okay.
Well, let me hit one other cool thing. I just want to say,
okay,
remember this on the Roth IRA too. No RMD when you hit 72. You don't have to pull money out if you don't want to. If you're still in a high income bracket and you're like, man, I don't even need this money. I'm still making money. I don't need to pull on my Roth. Keep letting it go and grow tax free. In the traditional though, at 72, you got to start pulling the money out. Okay. So that's another perk. If you a little differentiation on the Roth is it gets to keep staying invested. The traditional, you got to start pulling money out at 72 and taking your RMD.
Yeah. Another little side note, when you die, your family is going to have to pay tax on your traditional IRA, which is called IRD, income in respect of a decedent. And these are going to be typically younger people than you. You died, they inherited your IRA. What bracket do you think they're going to be in? And so if you're going to follow this Wall Street mindset of you're going to be in a lower bracket later, but then you die, we're jacked back up to a higher bracket with your family, your kids that inherit your money. But with a Roth IRA, they can take that money out penalty-free and tax-free in a Roth. So IRD
Yeah, good
and
point.
RMD. Two things we hate, RMD and IRD.
Yeah.
But I like OMD, Orchestral Maneuvers in the Dark, OMD, little 80s band.
Oh, the band? Okay.
Orchestral.
All right.
Is it Orchestral Maneuvers in the Dark? I saw them in concert, OMD.
Oh, okay.
I did. They were with Thompson Twins. 1986, baby.
Hold Me Now. Isn't that Thompson Twins?
Yep.
That's a good one. My band used to play that song.
Hold me now. Or everybody wants to rule the world. Did I hit that?
All right.
Did I nail that?
That was pretty good. All right.
Okay.
Let's close this out before
That's
everyone
obviously-
turns it off. Yeah.
Oh boy, I just
right,
lost
well,
some listeners.
Thanks
there.
everyone for hanging in there on Roth versus traditional. We hope that you got some principles from that. We know the math's tricky here, but just remember a couple points. One, do you want to pay tax on the seed versus the harvest? That's my number one thing of why I love Roth. We never know what taxes are going to be on the way out, but we do know that we're going to have a larger account on the way out. And I'd rather bite the bullet now and pay tax now on the seed and get the benefit of pulling out the big harvest, the larger amount at the end of the day with all the growth, the compounding, everything.
Yeah.
Zero tax on the way out.
And we did give 3 BSometers, but I'm not going to go with the fact people don't value or use the tax deduction, because I'll concede on that one a little bit that there is a value there. But I am going to say this. Here's my big takeaway is you could very well be in the same tax bracket later on in life that you're in now, or a higher bracket, because my clients don't want to retire on the same income they're making now. They want to, I'm sorry, they on less income than they're making now.
Right.
Yeah. It's just.
Yeah. And even if you're like, yeah, but you won't have a job. Yeah, but I better have $1 million retirement account. I'm taking nice, good, healthy distributions for a retirement.
Yeah.
Like
rental properties.
They're like, oh no, you're just going to take, we're just assuming you're going to take 30,000 from your retirement account a year. Okay. Am I moving into a mobile home? Where do you have me, financial advisor? Where am I living?
Yeah. Million? Psh, chump change.
And I'm going on vacations to where?
Yeah.
Like
4 Corners?
I gotta have an early bird special every time. That's the only way I get to eat out. The early bird special.
We're going to take a Southwest flight to stay in a Hampton Inn in Albuquerque, New Mexico, and I'm going to eat at Denny's. Now that's a vacation. You know,
Yeah.
Do the Breaking Bad tour. Save up for that.
Yeah. Could be worse.
Yeah. Okay. Thanks, everybody. Right. Hopefully this was helpful, and please share this if you did find it helpful, or do not share it if you disgusted or mad. And please give us a 5-star. We appreciate you. Thanks for viewing this on YouTube or catching this on the podcast. We'll see you next week.